Good morning. I'm Tim Nyland, and today we pick up where we left off last week in search of our stagflation clues. Today we are going to take a deeper dive into the inventory supply shock and its cost push role in driving inflationary expectations. Specifically, we are going to take a look at the 1970s stagflation and recessionary environment and draw similarities between that time period and what we are seeing play out now with the semiconductor supply shock impacting all industries, like 2021's OPEC Oil Embargo. Before we get started, please like, comment, and subscribe, and come back every week for more videos on investing strategy and making the most of Zacks Pro platforms. If you'd like to do the kind of analysis you're going to see in this video, then you're going to need to have a ZAT Portfolio Manager subscription, which includes both Zacks Advisor Tools and the Zacks Research System. Let's go ahead and get started. So as I mentioned, today's webinar is part 2 of the Stagflation Clues series. On the screen, you'll see that I've circled in red last week's webinar. If you haven't seen it, I encourage you to watch it. Really good, kind of sets the stage for some of the clues that we're looking for in our current economic state regarding the likelihood of inflation and stagflation. So before we get started, before we actually pick up from last week's webinar, a little bit of a history lesson we need to look at from the 1970s. So in 1971, President Richard Nixon decided to remove us from the gold standard, right? So when that happens, basically countries could no longer redeem the US dollars that they had in their foreign exchange reserves for gold. And at that point, it literally sent the price of gold skyrocketing and the value of the dollar more or less in a downward spiral. And keep in mind that, as is today, right, the bulk of OPEC oil contracts, they were denominated in US dollars. And so if you get a US dollar value that's plummeting, that's obviously going to hurt OPEC countries because their revenue is going to fall right alongside the dollar. So point number 6 here, on October 19th, 1973, the 12 OPEC members agreed to stop exporting oil to the United States in retaliation. Between 73 and 74, oil inventories collapsed and oil prices more than quadrupled. In 1973, the OPEC oil embargo contributed to that 1970 stagflation that we always hear about. So the key takeaway here is that OPEC oil embargo was a supply shock event that drove cost push inflation. And this more or less challenged traditional Keynesian economic theory. And along came a gentleman by the name of Milton Friedman. So let me just kind of outline very briefly how this took place. It's very important as we build our foundation here for understanding what's going on today relative to what happened in the 1970s. So again, the oil embargo at the time was widely blamed for causing that 1973 to 1975 recession. It was also blamed for actually causing the 81 and 82 recession. So the after effects of that oil embargo went on for almost a decade. In the 1970s, it was the Keynesian economists who had to rethink their economic models because that period of slow economic growth was actually accompanied by higher inflation, right? So in Keynesian economic theory, this was never supposed to happen. And so along came Milton Friedman, who did not believe that in cost push inflation itself. And I have a quote here from him. He believed that, in quote, inflation is always and everywhere a monetary phenomenon, right? So in other words, he believed that prices could not increase without an increase in the money supply. So there was this ongoing debate back and forth between Keynesian economists and Milton Friedman. And so Milton Friedman theorized at the time that the US government policies had actually helped cause the recession and the stagflation that accompanied it. And so Milton Friedman went on to theorize that to get the economically devastating effects of inflation under control during the 1970s, that the Federal Reserve should follow a constrictive monetary policy, in other words, pull back. And in 1975, Fed Chair Paul Volcker, who I've mentioned on prior webinars, actually put Milton Friedman's theory into practice. And he eventually drove down inflation and interest rates and triggered that longest fixed income bull run in history that is still with us today and that we've talked about. And in a 2003 speech, Fed Chair Ben Bernanke actually credited Milton Friedman with originating the thoughts behind what we call modern monetary theory. And so it was actually Milton Friedman that eventually gave credibility back to the Federal Reserve. So this all leads to the question, right? Why should we care about the events of the 1970s? And the idea here is that because in the 1970s, that cause of that stagflation, those recessionary events, it was a hotly debated topic and it was controversial. So you had one camp where it was, supply shock event. The OPEC oil embargo was literally driving cost push inflation versus the other camp that was saying, well, we've also got an increase in the money supply driving inflation. Now we know in 2021, there's no debating the risk that inflation poses to our economy, that semiconductor supply shock is currently impacting all industries, just like 2021's OPEC oil embargo. And that's driving cost push inflation at the same time we're increasing the money supply to record nosebleed levels. I'm not going to show any charts on that. We've looked at the money supply. We all know what's going on with spending, and we all are feeling the impacts of the semiconductor supply shock. So if anything, right, the 1970s taught us about the dangers associated with allowing inflation to get out of control. And this is why there's so much scrutiny on the Fed right now related to this expectation for inflation being more moderate versus getting out of control. So the credibility of the Federal Reserve is again once on the line, and they've got to keep inflation tame. Okay. So before we pick up where we left off last week, I wanted to offer viewers the opportunity to download 2 free Zacks analyst written research reports from our Focus List equity model portfolio. The Zacks Focus List is one of our most sought after equity model portfolios for a good reason. And that is it gives you a list of 50 stocks that are all positioned to outperform the market over the next 6 to 12 months. The Focus List is personally compiled by our Director of Research, Shiraz Mian, and is included as a standard add-on in most Zacks Advisor Tools service levels. So if you're a current Zacks Advisor Tools subscriber and you do not have access to the Focus List, please be sure to reach out to us so we can discuss your options. To show you the value of the Focus List and Zacks Research, we'll give you 2 reports from the list. These reports are free. There's no obligation. Just follow the link in the description below. And picking up where we left off last week, recall that I had outlined basically 8 of the clues that we need to look for this concept of stagflation. And the ones that I want to focus on are the ones that I bolded last week, and that is we need to watch the inventories. So we're going to focus on points 3 and points 4. So the supply chain disruption and the chip shortage specifically are things that I mentioned could be a real problem for us if these disruptions continued beyond 2022 and 2023. So this is where we're going to pick up. And it just so happens that literally last week when I was recording the webinar, that I happened to open up the business and finance section after I was done, and this is what I found literally on the front page. And what it says is that the chip shortage has hurt production and led to strategy changes. That's the caption underneath the image of that yellow Ford Bronco. And it says Ford to test a new way of selling cars, Ford shifts to custom ordering. And I started thinking about this, and it just so happened that I literally just published last week's webinar talking about the importances of inventory and to keep our eyes on inventory. And now we're seeing Ford Motor Company shifting to a just-in-time type inventory system for new car sales. And so this absolutely piqued my interest. And then on Monday of this week, I saw a new forecast, or actually new sales figures from semi.org. And semi.org is a website that I use to monitor what's going on in the semiconductor industry. And one of the things that I like to look at is the book-to-bill ratio. So anytime you have a book-to-bill ratio greater than 1, that is basically meaning that demand is exceeding supply. And in this particular announcement, just on August 23rd, which again is Monday of this week, what you see in the table is year-over-year percent change in the billings. Okay, so this is actual semiconductor shipments and deliveries. Okay, these are the billings. And you can see the year-over-year percent change is accelerating all the way up through June of 2021. And then the July 2021 prelim number is still almost 50%. And so this is massive, right? And this is taking place at the same time the industry experts are telling us that we're now going to have a chip shortage until at least 2023. So if I've got manufacturing, deliverings, and billings up 50, 60%, and I'm still pushing back the chip shortage deadline now until, or I should say the chip shortage forecast now until 2023, that would mean that my book to bill ratio, as far as my bookings, my demand for semiconductors, is increasing at even a faster clip. And so this got my attention. And at the same time, I recalled reading an article in the Wall Street Journal on Friday of last week where it said that Toyota is set to slash output as the chip crisis intensifies, right? So Toyota is going to slash production. So we've got the world's largest automakers basically all citing that this chip crisis is intensifying. At the same time, we have the industry experts pushing back the chip shortage forecast into 2023. At the same time, I'm seeing billings increase 50%. So we can't even catch up even with a 50% output increase on the billing side year over year. And so I did what any institutional portfolio manager would do, including Peter Lynch. And for those of you who don't know who Peter Lynch was one of the greatest institutional portfolio managers of all time. He ran the Fidelity Magellan Fund. Look into his methodology. He basically just preached, invest in what you know. And if Peter Lynch were looking at something like this today, he would basically go out and buy a truck and see what this is all about. So that's what I did. I went out and bought a truck, and I started on the internet at the Ford.com website, and I literally just put in all my information for what I was looking for. I went with one of the highest in-demand vehicles you can get right now, which is a Ford F-350 fully loaded. And it automatically chose my closest authorized dealer, which was Bell Ford here in Phoenix. I do live in Phoenix. And I put my information in here. I said I wanted one ASAP, and I clicked submit order, and literally within an hour, I had multiple people calling me, hey, come on in, we want to talk to you. And I said, great, I'll come on in. And so the first thing I did when I pulled into the car lot is I noticed something very strange, right? I hadn't been paying attention to this, but this is what the used car lot looked like at Bell Ford. And I don't know about you, but I do see a problem with this, right? I mean, there's literally no new cars. And you're looking at the test drive return spots here, but look beyond that. That's the used car lot. And there's no vehicles that you could even test drive to return. So this lot is completely empty, okay? Then you go over to the new lot, and I'm standing right by the showroom at this point, and I'm panning, and there are just a handful of new vehicles, mostly employee vehicles, so really no new cars. And then I turn around and I look to see if there's any cars on display in the showroom, inside or outside. You can see the picture on the screen. There's no new cars available. And so then I turned over to my left, which would round out like a 270-degree pan of the Ford dealership. And there was literally no new cars available. So the remaining 90 degrees would be the back of the dealership where the service department and everything else is. I didn't go back there, but clearly no new vehicles on the lot for anybody to come up and even look at, let alone test drive. Okay. So I walked in and I said that I was here to basically order the truck, and I was taken to a kiosk, and within 20 minutes and $85,000 later, I ordered a new truck from a kiosk at my local Ford dealer. And think about the implications for that for a minute, right? So this is what's called a just-in-time inventory sales model. And you've now got one of the world's largest auto manufacturers tinkering with this concept. Obviously, automobile supply is severely constrained, right? So traditionally, buyers have been price seekers, right? We go out, we shop for cars, we put one dealership against another, we get discounts, then we make our selections, right? It's not happening anymore. We're no longer price seekers. We're price takers. We're literally taking whatever we can get our hands on. So this is a huge, huge supply and demand shift, okay? It was supposed to be temporary. It's looking like it's a little bit more embedded now that Ford is contemplating this new sales model. The other thing is there's really no salesperson needed anymore, right? I basically had an assistant who couldn't even answer specific questions I had about options on the truck. He had to take my questions to the head of finance to get answers. So think of the tens and thousands of six-figure jobs associated with car sales in the United States. I mean, this was an excellent career. People could easily support a family of four as a car salesman in the United States. So what does the future hold for this group of jobs, this profession? And point number 4 here is really key, right? What used to be a 4-hour time drain to look at, test drive, and negotiate a new vehicle purchase was literally cut to 20 minutes, and I ordered exactly what I want. Now, the delivery was kind of hysterical because they said sometime in 2022. They could not even give me a date or a range. And so, again, I did this as a test. Will I actually take delivery? I'm not sure. I mean, if it ends up being that, cars are selling at $20,000, $30,000 above sticker in this range, I might just go ahead and take delivery, maybe resell it. Who knows? But really, point number 6 here, is it any wonder that the used car market valuations are up 40 to 50% or even more in some cases? So think about this, not only from the implications of the automotive industry, but think about how this can basically expand and apply to other industries as well. Think about the jobs, think about real estate, think about everything associated with that. And you can see the magnitude of what we're dealing with here. Let's take a look at AutoZone, right? This is an ECP name. It's at record highs. It has a Zacks rank buy. I mean, are we surprised? I mean, aren't you going to hold on to your used car a little bit longer, make repairs, perhaps make them yourself, save a little money? AutoZone with a Zacks rank buy. This is one of your beneficiaries. The next one, right? O'Reilly, another ECP name. Again, this has a Zacks rank strong buy. I mean, this is pretty significant. Only 5% of stocks in our coverage universe are going to have a strong buy. Again, same story as, let me go back to the prior slide, AutoZone. Okay, same story as AutoZone, right? Record highs. O'Reilly, record highs. Zacks rank strong buy. AutoZone, Zacks rank buy. Are we surprised? We shouldn't be. So what happens to these automotive sale-leaseback holdings in the REIT industry? Looking at those pictures I showed you and the fact that there's no new vehicles on major automobile dealers' car lots, would you want to actually be owning the real estate that these car lots operate on? What's going to happen to these sale-leaseback holdings in the REIT industry? We've got auto property REITs that are dedicated. I mean, this is a concentrated risk for companies like this. This one just so happens to be listed on the Toronto Exchange. Are we surprised it's a Zacks rank sell? I'm not sure. I mean, even though it's trading at record highs right now, when you start looking at the magnitude of this, this semiconductor shortage on the automobile industry, we need to start thinking about how these sale-leaseback holdings in the automotive space are dispersed across the REIT space. I mean, you're going to want to take a look at that if you're investing in real estate investment trusts for sure. You just want to make sure that you don't have too much exposure, perhaps, in these automotive sale-leaseback holdings. Okay. How does this change the competitive model now that perhaps these major automobile dealerships are going to be put head-to-head against CarMax, right? They've always competed, but now we're talking about competing at an entirely different level. Everything's going to perhaps be going online, and CarMax and several others already operate in this space, right? So CarMax, certainly a best of breed, Zacks strong buy used car sales, but these are things that we're going to want to consider, okay, going forward. What happens to names like Vroom, right? Zacks rank sell. Again, this is a competitive landscape shift, perhaps. that we're looking at here in the future. Same thing with Carvana. What happens to names like Carvana? Okay, these are those vending machines, or deliver to your home purchases of used vehicles. And what would stop all these other major automobile dealerships from entering that space now that there's no inventory? So we've got to think about that going forward. So 5 summary points here and 5 takeaways, right? The first summary point, the 1970s taught us there is no debating the risk that uncontrolled inflation poses to our economy, right? It's pretty much a consensus that we need to control this risk of inflation. The semiconductor supply shock is driving cost push inflation. At the same time, we are increasing the money supply to record nosebleed levels. We already know that semiconductor fabrication facilities are going to take years to bring online, and perhaps that's one of the contributing reasons why industry experts are now preparing us to expect the chip shortage to last into 2023. But there's something else I want you to think about, and that's point number 5, and that is, if they continue to drag this chip shortage out beyond 2023, we still need to recuperate our inventories, right? It's one thing to meet current demand. It's another to restock your inventory, okay? We're nowhere near that yet. So 5 key takeaways, right? The semiconductor supply shock is impacting all industries, just like the 2021, OPEC oil embargo, I should say, as if it were like a 2021 OPEC oil embargo. We only looked at the automobile industry. Consider all of the other industries dependent on semiconductors, and you'll begin to understand the magnitude of this risk to our supply chains. I mean, it's absolutely enormous. And we're also going to be hard-pressed to find any industry not impacted by the semiconductor shortage. And this is in the same exact manner that all industries are dependent on crude oil in some way. It just tends to work that way. Technology is literally the equivalent of what crude oil was in the 1970s, and to a large extent still is today. So the 1970s inflation debate of the role of cost push inflation versus money supply induced inflation, this is becoming more relevant today as we continue to push these supply chain bottlenecks beyond 2022 and 2023. Both of these factors are now fueling the threat of inflation. That's about it for this week. If you found this video helpful, please hit the like button below and be sure to subscribe for future videos. If you have any questions or ideas for future videos, please leave a comment below or email me at tnyland@zacks.com. You can also follow me on social media. I'm on LinkedIn and I'm on Twitter at Tim Nyland. If you're interested in getting started with Advisor Tools or ZRS, or if you're looking to upgrade your current subscription, please contact our world-class support at advisortools@zacks.com and ZRS@zacks.com. Thank you for watching, and I'll talk to you all next week.